let's talk about gold. And basically the title of this presentation is Just Buy the Dip. We're going to look at four different things. We're going to talk about fundamentals, at least how I look at the fundamentals, investor sentiment, the technicals, and in the end, hopefully I'll make the case here that it's a bull market, just buy the dip. One of the fundamental constructs that I apply to gold is looking at interest rates. In this case, I take two things, my bond model, and say, okay, if the bond model is positive, how does that affect gold? And then also look at the direction of yields on the 10-year Treasury. And if yields are falling relative to the past 26 weeks on the 10-year Treasury and the bond model is positive, that means that yields are also following. What happens if I purchase gold when those two factors are in my favor? And since 1977, you can see here through bear market, the bull market for gold started in 2001. You can see that we earned about 1,500 gold points with significantly less drawdown than a buy and hold approach, and with about one-half of the market exposure. So through a bear and bull market, we can see here that this is the equity curve line, that just this strategy of when yields are falling and my bond model is positive, saying that bonds are going to go higher, yields are falling, we can find a favorable time to be invested in gold. Buy and hold gold generated 1,500 points. So the question is what has happened since 2001? Let's just look at those times where my these factors for bond yields were not favorable for gold. And what we can see here is that this was 1980, that there was a spike here. Obviously, this is the end of the bull market in gold, and you can see here that investing in gold when those factors, those interest rate factors, were not favorable for gold, actually it was not a good time to do it. It was something that's happened here in 2001, and obviously it was the bull market in gold, and it appears starting from this point on, maybe it really didn't matter. Yes, it's nice to have those factors in our favor in the last 10 to 12 years, but in 2001 it really didn't matter. If we dig a little bit deeper and look at those particular trades, we can see here this is 2001. You can see all the negative trades here prior to that when those interest rate factors were not favorable for gold, and obviously that was here. Something happened here in 2001. It was the bull market. All of a sudden, what used to be no longer is, and I will say that again in a little bit when we talk about gold sentiment, that is what used to be no longer is something that we can say defines a bull market. And we can see here that you had a return at this arrow of 9.66%. You had a return of 26%, a return of 15%, even when interest rate factors were not favorable for gold. So this is something that we often see in other bull markets. Gold sentiment, and in this case, we're looking at the market vein. I'm going to blow this out just a little bit here, and this is from going back to 89. This is the market vein data here. This is a weekly chart of gold here, and what we see here is that from 96 through 2001, there was really just no interest in gold. When the investors, in terms of sentiment, market vein data, sentiment data, they showed very little interest in gold. Had a significant sell-off from $400 to less than $250. Something happened in 2001, and that is the old extremes here, that where gold always peaked out here. The old extremes, it didn't peak out. So what used to be no longer was, and now we're peaking out up here. And so this is some of the evidence that tells me, yes, we're still in a bull market, for gold, and that we're at the lower end of this particular range at least, but there has not been a change to sort of investors in terms of sentiment or how they feel about gold. This is a monthly chart of a gold continuous futures contract. This is your simple 10-month moving average in red. And this particular bar, these pink labeled bars, are what we would call negative divergence bars. Negative divergence bars tend to signify slowing upside momentum, and the highs and lows of the bars tend to keep price within the highs and lows of the range until there's a breakout in either direction. And that's exactly what we're seeing. This is over 12 months ago, this particular bar where the green arrows are. This was from September 2011, so almost 15 months ago, I guess, 16 months ago. And you can see this wide range negative divergence bar that prices really just have stayed within the range of this particular bar. We haven't yet seen a close below that. To me, this is just telling me that we're range bound. We're looking here at these key pivot points. These are sort of a technical idea that I've come up with where we're looking at buying and selling, or the best areas of buying and selling. And across multiple assets, I can tell you that 3 closes below, 3 of these would represent a bear market. We have yet to have that, and those prices sort of just drifted down here to the 1578 level. To me, a weekly close below this level would represent a high likelihood that we have entered into a bear market. Until that happens, and the breakdown on the monthly chart, to me this still looks like a bull market when you also take the I think you need to buy the dip here. And technically prices, I've just scrunched this down, and this is giving us a look here going back to, let me see if we can get our pointer going here again. This is giving us down to 2004, 2005 time frame. And what we can see here is that gold is very oversold here. If you look down here in the right-hand corner where my mouse is spinning, and same thing here, here. These were all, I'll put the cursor here, good times to be buying gold. Why do I think it's a good time? Because it's a low-risk entry. We have support here at 1578. Gold has been consolidating for over 18 months, over approximately 15 months now. And by my measures, is just any old indicator that I've developed, this oscillator type indicator. You can see here that it's a bull market until it isn't. In other words, you should be buying buying the dips against the trend. Is this indicator a panacea? Absolutely not. If you want to go back here, you can see here the market was oversold. There's our close below 3 pivots. I'll highlight that here. And you can see how this particular thing here, this basically was showing us that this was a market that risk here. There's our close below 3 pivots, and it keeps going again. And if you want to see our bull market, basically a close above 3 pivots, and that's here at 2002. So the bull market tends to make geniuses of us all.